Welcome to Stoxies. Today, I asked artificial intelligence to find two stocks that could potentially take off. And the interesting part is that it didn't give me two similar choices. It gave me one of the most stable companies in the world, and one that is pure risk, a stock that has already made some crazy moves in the past. To do this, I gave the AI data about where the market is heading, the growth of artificial intelligence, interest rates, and which sectors currently have strong momentum. And what came out was actually very interesting. The first stock is the quieter one of the two, but maybe also the most important, because without it, AI simply wouldn't exist. The first stock is Taiwan Semiconductor Manufacturing Company, and there's a reason why AI picked it. It might not be one of the companies you see in the headlines every day, but in reality, it's one of the most important companies in the world right now. The reason is simple. Taiwan Semiconductor Manufacturing Company manufactures the most advanced chips available today. And these chips are what power the entire growth of artificial intelligence. Think about it this way. Companies like Nvidia and Apple rely on it to build their products. Without TSMC, all this AI growth we're seeing simply wouldn't exist. And here's the key point. As AI continues to grow, the demand for these chips keeps increasing. So even if it's not the most flashy stock, it sits right at the center of this massive technological expansion. In simple terms, it's not a stock that will necessarily hype overnight, but it's the one working in the background, supporting almost everything. And that's why many see it as a more stable way to invest in AI. If you look at the performance of Taiwan Semiconductor Manufacturing Company over the past 5 years, you'll notice something very clear. It's not a straight line, but a cycle of strong rallies and corrections on top of a broader upward trend. Starting in 2021, the stock moved sharply higher, driven by massive demand for chips. During that period, the global semiconductor shortage gave it a strong boost, pushing the stock close to all-time highs. Then in 2022 came a major correction. With rising interest rates and broader pressure on tech stocks, the share price dropped 30 to 40% from its highs, following the overall semiconductor sector. In 2023, we saw a gradual recovery. The market started to price in AI growth again, and TSMC began to move higher, gaining roughly plus 20 to plus 30% from its lows. But 2024 and 2025 are where things really picked up. With the explosion of artificial intelligence, demand for advanced chips surged again. This pushed the stock into new upward waves, at times rising more than plus 40% from cycle lows and moving back toward previous highs. Looking at the full 5-year picture, the pattern is clear. The stock can fall sharply during difficult periods, but each major correction has historically been followed by a strong recovery. And that's because it's not just another tech stock. It's one of the core pillars of global chip production. The second stock is Upstart Holdings. And this is where things completely change. We're not talking about a quiet, stable company like before. We're talking about a company trying to transform how the entire lending system works. The idea is simple. Instead of relying on traditional credit scores, it uses AI to decide who qualifies for a loan. In other words, it's trying to replace the way banks make decisions, with algorithms. And this is where it gets interesting. Upstart Holdings has already shown what it can do. The stock has surged massively in the past, and then dropped just as sharply. It's one of those stocks that moves very fast, both up and down. Why? Because it's extremely sensitive to the economic environment, especially interest rates. When conditions are favorable, it can grow very quickly. When they're not, it comes under heavy pressure. In simple terms, this is not about stability. This is a pure bet on AI. If it works, the upside can be significant. If it doesn't, the risk is just as high. If you look at the performance of Upstart Holdings over the past 5 years, you'll see one of the most extreme journeys in the market. From a massive rise, to a dramatic, and then a volatile attempt to recover. In 2021, the stock surged to nearly $390, driven by strong optimism that AI would transform the lending industry. Investors expected rapid growth, and the stock reflected that excitement. Then came the major decline. In 2022, the stock lost more than 90% of its value from its highs. The main reason was a shift in the economic environment. Rising interest rates and tighter financial conditions made investors pull back from high-growth companies. In 2023, we saw the first strong reaction. The stock rebounded sharply, gaining over 200% from its lows, as the company proved it was still active and relevant in the market. In 2024, the recovery continued more steadily, with improving business performance and a more balanced market view. By 2025 and 2026, the stock remains highly volatile, moving roughly between $20 and $90, showing how sensitive it still is to economic conditions and interest rates. Looking at the full picture, the pattern is clear. From a huge rise to a massive fall, and then an unstable recovery attempt. Upstart Holdings is not a stable stock. It's a stock that moves aggressively, depending on the economy and how much confidence investors have in its future growth. If you now put these two stocks side by side, you'll see two completely different worlds. On one side, you have Taiwan Semiconductor Manufacturing Company, a company working behind almost all the technology we use today. It doesn't move aggressively without reason. It tends to rise and fall more smoothly, following the market cycle and the demand for chips. On the other side, you have Upstart Holdings, a company that behaves very differently. It shows large upward moves and sharp declines, with much more volatility, because it depends heavily on the economic environment and interest rates. The difference is clear. One is closer to stability and real technological production. The other is closer to risk and future expectations. And that's what makes this combination interesting. Because it doesn't just show you two stocks, it shows you two completely different ways to approach investing in AI. Before we wrap up, it's important to look at the other side. Because no matter how interesting these two stocks are, it doesn't mean they always go up or that anything is guaranteed. For example, Taiwan Semiconductor Manufacturing Company can be heavily affected by the global environment. Economic slowdowns, production issues, or geopolitical tensions can all impact its performance. On the other hand, Upstart Holdings is even more sensitive. It is strongly affected by interest rates and overall lending conditions. When the environment becomes challenging, this shows up quickly in its results. Also, both companies operate in a fast-changing space. Artificial intelligence brings huge opportunities, but also intense competition and rapid shifts. So the key takeaway is simple. There is opportunity, but there is also risk, and the two always go together. If you put everything together, the conclusion is actually quite simple. On one side, you have Taiwan Semiconductor Manufacturing Company, a company that plays a key role in the entire evolution of artificial intelligence. On the other side, you have Upstart Holdings, a company trying to transform an entire industry, but with much higher risk. There's no right or wrong choice here. There's only a different way of thinking. And in the end, the real question isn't whether these stocks will go up or down. It's how much risk you're willing to take. If you liked this format, let me know in the comments what you'd like to see next. More stable options or even higher risk plays. And if you want more content like this, don't forget to subscribe so you don't miss the next videos.